Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with the second April monthly market update to address market volatility and trade policy. Before we begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So we hope to see many of you this coming Wednesday at our quarterly investment forum, where we'll be unpacking all of these items in a lot more detail. Just to jump right into it, the markets are off their lows, with closing a couple days ago at just under 5,400 as of Friday, the 25th. We're in the 5,400 range on the S&P 500, so down for the year, but well off lows. And this is just a look at kind of intra-year declines going back to 1980. And what it says is the average intra-year decline is 14%, yet markets over this period of time were positive 34 of the 45 years. This year, as an example, we're down 19% from high to low. And again, we've currently, as of a recent few days, cut that roughly in half. Still down, but about half as much as we were down just about a week ago. And this is a look at just how markets tend to respond after their worst trading days and months. So these are the worst 15 trading days, and their average day was down 9%. And their average return 1 year later is 31. If we broaden that out and look at an average month, on the worst months, you look at an average down 11.5 and a 23% return after. So the elephant in the room is trade policy and tariffs, which are working their way out, but it brought on a lot of uncertainty, and that uncertainty has led to volatility. So a few words on that, just kind of why they're used. They're taxed on imported goods. They're used for a variety of reasons: raising revenue, encourage local production, reduce reliance on foreign goods. And their potential impact is raising prices and can impact economic growth. So we'll talk about that. Just to kind of talk about historically where tariff rates have been, that we're coming off of a really low amount at 2%. Now, this is a long graph going back over 200 years, but you'll see even in a World War II time frame, tariffs have been much higher. They're very low today. And total revenue or total tariff revenue as a percentage of overall revenue is also very low. And our tariff rates compared to other developed countries is also pretty low. So I say that just as context. This also looks at our exports as a percentage of GDP. So we're much less impacted in that our exports are only 11%, versus you could look at Germany as an example. 43% of their GDP is export related. So kind of what are the results? And again, things are changing literally by the minute in markets, and comments are affecting markets, which is leading to volatility. But there's really three possible results of where all of this leads in anywhere from 90 days to 6 months from now, either positive, negative, or somewhere in between. And because all of these are uncertain, that leads to a lot of volatility, which we've seen in financial markets. The other thing that we don't know is what markets are pricing in. So our market's pricing in a negative outcome such that even in between outcome, the market's like, that's also impossible to know. Again, this is a recent comment, which is worth thinking about as it relates to what markets are pricing in. So if markets priced in at the low point an average effective tariff rate of 25, and we wind up closer to 15, is that a tailwind for the market? So again, we don't know which of the outcomes the markets are pricing in, but it's worth considering that the markets are pricing in a certain result, and that changes again day by day, to where all of this will lead over a 90-day to 6-month period of time. As it relates to other items, the economy is slowing, but still positive, although expectations for a recession have picked up by analysts. So that's something that we're kind of waiting to see. And part of this issue with market volatility is the tension between soft and hard data. And we'll just kind of give you some ideas here of how people feel, whether it's coming from media or investor confidence or market sentiment. And you'll see that in some of these areas, inflation expectations, that's better, but sentiment, employment expectations, and consumer confidence are all down recently. Now, the hard data is more things that you can measure more easily: GDP, retail sales, unemployment, inflation, et cetera. So one of the questions is, as it relates to market volatility, is will how people feel turnover into hard data in terms of how people spend, how employers hire, how they spend and invest in their businesses. So that's something that we're keeping a careful eye on. CPI had a really good print recently, with CPI at 2.4 and core, which excludes food and energy, at 2.8. So again, heading the right direction, still above the Fed's target of 2. But that's overall a positive note. Another thing that's picked up amid all the volatility is a higher expectation now, a 53% chance that the Fed will cut rates 3 times this year. So that's also something that is positive. We also had a good March jobs report, although we lowered both January and February. But again, overall, 228,000 new jobs in March was a good number. So just to kind of summarize some tailwinds and headwinds to be looking at going forward, some potential positive things that could happen are tax cuts, deregulation, and you could move from an extreme pessimistic standpoint to a more optimistic standpoint if either of these happen, or some more certainty as it relates to trade policy. And the headwinds are the obvious: trade tensions is the key one now, but also budget deficits. We're running a $2 trillion a year deficit. And you could also have kind of labor market tightening, which is inflationary. We did recently rebalance, and we sent trade notes out regarding that. So if any questions about any of that, feel free to let us know. And again, this is just zooming out to a longer period of time. Market volatility is always tough and painful to work through. But if we look at 100 years in the market, 73 of those 99 years are up, and the average return on the up years is 21.5%. versus 26 negative years, and the average down years negative 13.4. So both the frequency and the momentum are on the upside of markets. Now, all of these negative periods of time, like the ones that we're in, are tough to work through. But it's important to know that, again, on both a frequency and momentum basis, the market's up far more than it's down. So again, we look forward to seeing over 100 clients at our event this coming Wednesday to talk about all of this in a little bit more detail. None of this is a substitute to contact us directly about how all of these things impact you. So if you have any questions at all, please reach out to you. We're here to serve you. So with that in mind, we'll close. Again, we hope to see many of you next week at our upcoming quarterly investment forum. If we don't see you then, be well and take care, and we look forward to seeing you again real soon.